Simran, I can't hear you. Hello.
Yeah. Am I audible now, Vivek?
Yes, yes.
Yeah. So we are live. Hello, good evening, everybody. Hope you all are doing great. Thanks for taking the time to join us today for our monthly Rebalance AMA webinar. It's good to see a lot of people tuning in. So welcome, everyone. Let's just wait for a couple of more minutes for people to join in. Think we are good to start. My name is Simran,
No?
and I work in the marketing and business development team of Gulaq, and I would be moderating today's session. We also have with us our speaker, Mr. Vivek Sharma, who most of you may already know. But for those who don't, he is the investments head at Gulaq and brings in years of experience in markets and investing space. Welcome, Vivek.
Thank you, Simran. Thanks a lot.
So let everyone know, we do these webinars monthly, wherein we get a chance to interact with our existing investors and some new people as well. We will be giving you update on the latest rebalance and on how our portfolios have performed. We also will be taking your questions, doubts, feedbacks that you may have. We already have received a few questions from our investors through the Google form, which we would be covering first, but we would also have a Q&A section towards the end, wherein you can get a chance to ask your questions directly to Vivek. So please feel free to put in your questions in the chat box, and we will try to take up all of these during the end of the session. So let's start with what we have prepared for you today. Before we jump into the rebalance update, let me also give you a little background on who we are. At ST, we have been at the forefront of systematic investing for over 15 years now. Our entire approach to investing is quant driven, meaning we use data, research, and algorithms to make decisions. We have been in this game since 2008 when SEBI permitted algo trading in India and are currently managing an AUM of over 1500 crores. ST offers portfolio management services to HNI investors, but we didn't want systematic investing to be limited just to the high net worth investors. So we created Gulaq, our retail focused investing solution. So, what is Gulaq and how is it different from PMS? Well, it's built on the same methodology as a PMS portfolio, but you don't need a massive portfolio to start with. We have lowered the ticket size to make it accessible to everyone at Gulaq. We have been around for 4 years and have already helped more than 25,000 investors make data driven investment decisions. Our model portfolios are available on platforms like Smallcase and PickRight. Moving on to the next slide, this is our core team at ST. We have Mr. Sandeep Tyagi, who is the CEO and chairman of ST and founder of Gulaq. Having done his BTech from IIT Delhi and MBA from Columbia Business School, he brings an experience of 30 years in the industries of analytics and finance. Mr. Vivek Sharma over here is the investments and market head at Gulaq. He has done his BTech and MBA both from IIT Kharagpur. He has an experience of more than 20 years in the markets and investment space. So, along with the leadership team and our in-house experts at ST, our aim is to simplify investing for everyone, whether just starting out or are already a seasoned investor. Before we move ahead, just a quick note on the disclaimers as well, as we are a SEBI registered investment advisor. So, moving on to the next slide, it is our responsibility to inform that investing in securities markets come with risks. So, investors should go through all the documents carefully before making any decisions. The securities mentioned today are just for illustration and shall not be treated as recommendations. Our SEBI registration details and address have been displayed on the screen, so feel free to pause and review them if needed. Yeah. So, all right, that's enough from me. Let's get into the real reason why you're here, which is to learn about your rebalance and the portfolio. So, Vivek, I would request you to let our investors go through the same.
Thank you, Simran. Thank you, and good evening, everyone. So I'll start with our market cap portfolios. These portfolios are getting good traction amongst experienced investors now, and we launched these portfolios couple of months back. So these are focused selection of 15 to 20 stocks in each of these large, mid, or small cap category, and the methodology is similar, which is the multi-factor methodology, and we follow the monthly rebalancing for market alignment. Let's just go through how they have been performing and also what is the expected performance uh, as per the back tests, right? So since the launch in December 24, markets obviously have been quite bearish. Our large cap portfolio is down roughly around 8% as compared to the index. Whereas if you look at the historical backtested performance, if you look at the historical backtested performance, just to get an idea of what is to be expected from these kind of portfolios, uh, historically Nifty 100 has given about 13% CAGR over 10-year period, whereas from this particular portfolio, we would expect about 20%, so an alpha of 7%. Again, in the back test, what we have assumed is we have assumed the DP charges, we have assumed transaction charges, slippages as well at a 1 lakh portfolio size. The mid cap portfolio, again, it's slightly down about 4 to 5% since inception as compared to the index. But in this, if you look at the expected alpha across years in the backtested performance, obviously uh, that has been great. And even in small case, if you small cap stocks, if you see the expected 10-year CAGR is quite healthy. And the alpha that if we were to actually replicate this, it would come out to be really, really very healthy. This is again accounting for all the transaction cost and DP charges. Since inception in this also, we are slightly down about 2%. So small cap index has been down since December about 22%, whereas we are down about 24%. This has been the performance, which is fairly small time period of about close to 3 months. Now, moving on to the Gulaq portfolios, as you can see, the minimum investments across gear 6 starts with 24,000, moving all the way up to 80,000 for gear 3. The only difference in these portfolios is in the asset allocation. Otherwise, if you look at the equity component of any of these portfolios, it's exactly the same set of stocks. Why we have launched this is obviously there are many investors who really don't want to take very aggressive bets and what would like to uh, invest via proper asset allocation amongst multiple asset classes, and that's why we have launched these kind of portfolios. So Gulaq Gear 6 and 5 are obviously meant because they have very high equity exposure. They are meant for very aggressive investors. Gulaq Gear 4 or 5 also can be considered by moderate investors, and Gulaq Gear 3 is conservative to moderate. Gear 3 has about 60% debt, so it's quite, in terms of volatility, in terms of risk, you're taking very low risk in Gear 3 or Gear 4 portfolios. Now moving on to the rebalance update for March, you can see over past couple of months how our large cap, mid cap, small cap allocation has moved in gear 6, and for the month of March we have increased our allocation to large cap by about 21%. So currently it's 38%, mid cap is at 37%, and small cap is at 24%. In terms of sectoral weightage, we have moved up in terms of from Feb to March in industrials, healthcare, financials, and energy. These are the ones where we increased our weightage, whereas in the others we have we have reduced our weightage. If you compare to the BSC 500, we are still very underweight in terms of financials, which is the biggest component in BSC 500. But for us, it is closer to 13% only. And next big one is IT also, IT and consumer discretionary. In IT also, we are quite underweight uh, versus 10, we are at 4.7% versus almost 10% in IT. In consumer discretionary also, we are closer to half. We are overweight on sectors like industrials and healthcare, where we have almost double the allocation, which is present in BSC 500. In terms of factor weightage, you can see leverage. This specific one, momentum we have reduced and we have gone down to zero. Momentum in these markets is not really working or working against us. So momentum now in this month has been zero weight, and almost all the weight is between value, which is 74% to value, and 26% to leverage, which is uh, these are the weightages that we have assigned to multiple factors. And again, these weightages are not decided by us. Rather, this is also a very systematic approach that we follow while figuring out what is the weightage that needs to be allocated to each one of these factors. Gear 6 performance last 1 year hasn't been that great. We have been underperforming the market in last 1 year. Last 1 year, we are down as compared to the index about close to 8%. However, if you look at the longer term performance, it's still very solid. And since going live or since last 4 years, we have produced very healthy alpha, even accounting for these drawdowns that we have had in last 1 year. Our overall alpha that we have been able to produce in this product is pretty healthy. Same is with Gear 5. Last 1 year has been, this is in fact the first year out of last 5 years that we are underperforming the benchmark. And that is the case with active equity investing, that it's really very hard, almost impossible to beat the markets year after year. So once in a while, you will have a year where your kind of strategies are not really very conducive, maybe for the markets. So once in a while, you will have these kind of bad years. But over long run, even in this portfolio, we have produced decent alpha. Considering again here, uh, our asset allocation in this one is 80% equity and 20% in debt. Gear 4, which is actually Gear 4 is quite popular in terms of asset allocation, the 60-40 portfolio, which many investors really like that kind of allocation, in which they assign 60% to equities and 40% to debt. World over, very popular and very widely followed portfolio, the 60-40 allocated portfolio. Now, if you look at this, again, the beauty of this is because you are now 40% in debt, the drawdowns in these portfolios are much smaller. So in last 1 year, this specific portfolio is down only about 2%. So there's still definitely some negative alpha because the equity hasn't worked really well. But in terms of absolute performance, also, if you see, it's just down 2% as compared to equity markets down anywhere between 10 to 30%, depending on what index and what sector you are looking at. And even in this, we have been able to produce decent alpha. This we it has a 2 year track record only. Okay, and this is Gear 3 performance, which has 40% equity, and the majority of allocation, which is 60%, is to debt. Okay, so this has been the overall performance of the 4 gears as compared to the Nifty Multi-Cap Index since the time we launched. So as I was mentioning earlier, this is the first year, the calendar year 25, where we have actually underperformed the benchmark index. And prior to that, every single year, we have been able to produce pretty solid alpha. Last year was also not that great for us. We are kind of matching the benchmark. Uh, and and this year has been down. We have given negative alpha. But again, if you consider longer term performance since the time of our launch, the index, which is the multi-cap index of Nifty, has given about 22% returns. Excuse me. And our returns have been almost double of that. Yeah. So now let's talk a bit about the market correction. Now, just to go a bit deeper into what this correction is about, we look at the the market caps. So Nifty 100, which is the large cap index, from the peak, it has come down 18%. Now, this is as of February 28th. The mid cap has given about 21% from the peak, and the small cap has been the highest to correct, which has corrected 26%. These are very, very strong corrections. And overall, if you see Nifty 500 has corrected about 19%. Nifty 500, just for your reference, would have about closer to 75% in large caps, and rest 25% would be in the next 400 stocks, which is a combination of mid cap and small cap. Now, again, if you look at the breadth of this market correction, in large cap, you have 100 stocks, mid cap, you have 101 to 250, so 150 stocks, and rest 250 are in small cap category. Now, if you look at this breadth of correction, out of overall 500 stocks, uh, out of 500 stocks, if you look at, let's say, 20%, because that is the drawdown that we have seen, about 20 to 25% in Gulaq also, more than 110 stocks. So 410 stocks have been going down 20% or more, right? And this has been the same across. So it's a very widespread kind of market correction. 64 stocks has seen 20% or more, and 91 stocks has seen 10%, right? So if you consider 20% or more correction, 64% of the stocks has seen. So this is a very, very widespread correction, and that's why you are seeing the pain in almost all the portfolios. So this is our Gulaq and Gulaq portfolios, which are fairly concentrated. But even if you see the more diversified portfolios, you would see that the correction is of the similar order of 15, 20, or 25%, or even more for some small cases or mutual funds. So it has actually impacted us also, and the overall market also quite a lot. In terms of EPS and PE, this is the large cap. So if you consider the peak, which was around September of 26, the Nifty is obviously down about 18%. But if you look at the EPS, earnings per share, for these Nifty 100 companies, that is actually up 6%. So overall, the price to earnings, which is a metric of the valuation of where these companies are currently trading, this is currently at 21. And the longer term PE, median PE, has been 22. So now, at least in large caps, we are very fairly valued or slightly undervalued as compared to the longer term averages, longer term PE average. Now, if you look at mid cap, also same is the thing, similar, that we have seen 21% correction, but overall the earnings per share of these companies from September till 28th of February is up 7%. And the valuation is down almost 26%. It's still, mid cap is still, the median PE is 27 versus the current PE of 33. So they're still, as a group, they are overvalued. Obviously, now we are seeing quite a few stocks in the mid cap space, which is below their longer term valuations as well. In terms of small case, this presents a slightly different picture in the sense that the earnings per share of small cap companies is down about 8% since the peak. And the valuations are also down about 19%. And if you look at the median PE, historical median PE, which is 25 for small cap, so now, as of February 28th, we are closer to that longer term average valuation of about 25, 26 PE in the small cap category, right? Now let's look at the historical drawdowns also since the time we launched. So this is the first time that we have seen this steep a correction. So we are currently, since in this phase, we are down about 26%, right? And we have seen some of the corrections in the past, but obviously since May 2020, it has been one way up only. So we have seen corrections of about 10 to 15% earlier, but at least in our live track record, we have never seen this kind of correction. So this is the first time. But if you consider the historical drawdowns as per the back tests, so as per the back tests, we have definitely seen these kind of corrections. And uh, in Gulaq Gear 6, we saw one correction during the COVID time. We saw 26% corrections as per the back test, and we've seen one correction in late 15, early 16, 2016 of the order of 20%. So we have obviously seen some corrections. So this is obviously hurting us, our portfolios, but at the same time, uh, this is not something which is abnormal. We have seen these kind of corrections, and these kind of corrections are to be expected every couple of years in equity markets. In terms of cone of confidence, also, if you see this, what this tells us is what is the best performance as per the uh, historical expectations. What is the best case scenario, the worst case scenario, and the average scenario? So if you see over short run and slightly over long run, also we are now closer to the worst case scenario as of now. So now moving on to the questions that we have received, I'll cover them related to product. These questions are related to risk and return, and also the on the investment methodology. So related to product, we have these questions. Brijesh has asked us, I have been a Gulaq Gear 6 subscriber for over a year. I want to know if Gulaq or ST plan to launch a specialized investment fund, SIF, for investors with a corpus of between 10 to 50 lakhs. This would allow us to trade your algorithms while minimizing rebalancing leakage and reducing the hassle for investors. So Brijesh, and for everyone involved here, now, SIF, this is a new product category which SEBI has come out. Obviously, these haven't been launched yet, but they'll be launched in the next few quarters by mutual fund AMCs only. Now, what are, these are slightly, it gives more freedom, flexibility to the fund manager to do different kind of strategies, and you could as well involve futures or options in these funds as well. Now we definitely do have the algorithms of related to futures and options also, but these SIF is only meant for mutual fund investors, and only those companies who have the AMC license would be able to launch these SIFs. So we do not have any mutual fund AMC license as of now, although we are in the process of applying, but that is slightly a medium-term plan. So you might see mutual fund from us maybe 2 3 years down the line. But as of now, we are not in a position to launch these SIF funds. But we do have plans, obviously, over long run. Irrespective of market corrections, why should I invest in Gulaq instead of any other fund? What is the key differentiating factor? We rarely discuss this. Question has been asked by DC. So I think we have discussed this couple of times, but I'm happy to discuss this again. In my mind, the differentiating factor is that we are able to look at markets holistically without any emotions and without any bias. I think those are the key advantages that I personally see in quant funds. Quant funds are able to analyze, able to process tons of data that is out there. So you have huge amounts of data related to individual companies, related to sectors, related to even market and overall economies, right? So a quant fund is able to process that huge amount of data at a quick speed and is able to take decisions. And that is why you see us rebalancing our portfolios on a monthly basis. Whereas in a traditional approach, which is different, in which the fund managers and analysts analyze these companies, they look at competitors, they talk to management, they go and do surveys in the markets. So that's a very different style of investing. uh, they take far more longer to decide, but when they decide, they also hold those stocks for much longer. Whereas for us, the holding period is on average about 3, 4, 5 months only. For them, the holding period would be at least in couple of quarters, if not couple of years. So I think that is a key differentiating factor, uh, which you don't see in many other funds. The approach, this quantitative approach. And secondly, this approach that we at ST follow is a multi-factor approach where we are following or tracking multiple factors, and these factors are a combination of technical factors, fundamental factors, as well as macroeconomic factors. So we are taking a 360-degree view of each company and each sector and overall economy. That helps us uh, take better decisions, and that's why if you see our longer term performance, that we have almost given double the returns of index in the time that we have been live in the markets. So this is, I think, the key differentiating factor of us. नेक्स्ट क्वेश्चन इज बाय सुमित, गुल्लक गियर 6 लॉन्ग टर्म में एक म्यूचुअल फंड से बेहतर कैसे है? सो सुमित, if you compare same strategy being run in a mutual fund structure versus a small case structure. So I totally agree that mutual funds, because of the taxation advantages, mutual fund is a very good structure. And if you get similar strategy in a mutual fund structure, obviously that is much better. Uh, so mutual funds, obviously, no brainer, the same strategy being done in mutual funds is definitely better. However, having said that, I don't think the kind of strategy that we are running, a very exhaustive multi-factor methodology that we are running, is available in mutual fund under mutual fund categories. So that is why, at least as of now, a part that's what we advise, that a part of your portfolio can be in quant fund, in this specific Gulaq Gear 6 quant fund. But I totally agree that mutual fund should be a bigger part of someone's portfolio. It should be diversified. So we have never recommended anyone to go all in one of our funds. It should always be well diversified portfolio of 4 to 5 funds, and Gear 6 could be one of the funds, right? Now, in terms of overall performance, if you see, I'll just explain in terms of, if you are invested in a mutual fund index fund, which is a, let's say, BSE or NSE 500, how that will pan out to be, or at least history since the time we have launched. This is the return profile of NSE 500 versus the Gulaq Gear 6 return profile. Right. So over 5 years, this is what we have done as compared to NSE 500. Now, in these returns, in this specific analysis, what I have done is I have considered that you have invested 10 lakhs each in NSE 500 and 10 lakhs in Gulaq Gear 6. Now, in Gulaq Gear 6, because you are rebalancing on a monthly basis, whatever gains have, you are paying 20% short-term capital gains tax. Whereas in NSE 500, only at the current moment, because we have to see what is the money that you can use. So after paying taxes, you'll only pay taxes once at the end, and that will only be 12.5% in NSE 500, whereas you are paying 20% every year in Gulaq Gear 6, 20% of the profits. I've also considered 3% additional cost in Gulaq Gear 6 for brokerages and rebalancing and slippage cost. And I've also considered the fixed subscription cost of 5,800 per year in Gulaq Gear 6. Right. If you consider all of these costs in Gulaq Gear 6, still you will come out ahead. So had you invested 10 lakhs in an index, NSE 500 index fund versus Gear 6, even after incurring these costs, these three kinds of costs, you'd still be ending up ahead, at least in terms of investing in this specific index. So that ways, we are definitely we have been able to create good value over the last couple of years to our investors, in spite of the additional cost that they bear in this specific small case structure. Moving on to the next question, we are constantly churning stocks every month, booking losses and incurring transaction costs, yet there is no sign of performance. Ideally, it should fall less in declining market and rise more in a rally. I am worried that this rate capital will eventually erode completely. So, see, this time definitely we are having losses, but I think this is a part and parcel of active investing or even investing in equity markets. So when you're investing in equity markets, you have seen COVID fall, where markets fell more than 50%, right? The last prior to that, even in 2008, markets fell 50%. Those are very big, meaningful corrections, right? Uh, every 10 years or so, there is some big event uh, due to which markets fall almost 50% or so. Right. Every 3, 4, 5 years, there's bigger, there's smaller corrections of the order of 20, 25%. And every maybe 2 years or so, there are smaller corrections of 5 to 10%. Now, this is very, very normal. The reasons would be different, and it's very hard to predict when these corrections would happen or for how long they'll last. But equities as an asset class is still, in spite of all of these risks, equities is still the best asset class in order for you uh, to make your money grow, right? That is one thing with equity markets. And secondly, with active investing, where you're trying to beat the market, where you're trying to beat the index. In active investing, also, the upside is that if your fund that you have invested in works well, you will be able to make more money than had you been invested in an index fund. Or if on the other side, if your fund is not performing as well, then you will do even worse than index. Right. So in the short run, yes, Gulaq Gear 6 hasn't done well. Uh, but over long run, over 3 year, 5 year period, we have delivered very good returns. And this is not only about us. I think with any active fund, no matter how good it is, there are times when it underperforms the market, and you've got to stick with it. And I'll come back to that famous uh, story about Peter Lynch. Peter Lynch managed Magellan Fund for 13 years, in which he delivered 29% CAGR, whereas the S&P was growing at about 13% only. So huge underperformance over a fairly significant uh, period of time, 13 years. And when he retired, the study was done as to how much an average investor made. And actually, it was found that the average investor in that fund actually lost money. Their returns were negative, even though he delivered in the fund 29%. And that is only possible because of the emotions of the investors. So what usually happens is, after a couple of years of rise, investors get really excited and they invest. Uh, and when the markets correct, that is the time they exit. So mostly what is happening is they're getting in at the top, and when the markets are correcting, they're thinking about withdrawing. And that is what we are seeing these days also. And that is, I think, that's what kills your portfolio. So that is something that we should be very aware of, not only in Gulaq Gear 6, but in any equity fund that you are investing in. That this, if you are a long-term investor, this is actually a very good time to not only stay invested, but continue with your systematic investment plan in whichever funds that you are doing. Next, I'm specifically talking about Gear 6. I've been investing in a staggered manner since July, but my portfolio is down 22%. I don't have additional funds to average on. Will I still be fine in the long term, or this investment is headed? So, Yashasvi, see, the best thing obviously to do is uh, to invest in a systematic way. But in your case, you are saying that you have already invested. See, if you consider equity investments, again, they are meant for the longer term. So in the short run, I really do not know whether the markets have made a bottom or not, or how much further down they'll go, or whether they'll start going up from here. Frankly, we do not have any idea. We might have our own biases, but that is not at all useful for you as an investor or even for me. What we follow is a very, very systematic approach to investing. And over long run, and we have seen this in the past also, even with Gulaq, whenever the markets have given us a drawdown, Gulaq, at least in the live market since last 4 5 years, Gulaq has been quick. Whenever this uh, correction to the upside happens, Gulaq almost always have been quicker to recover these losses and come to profit. So that's the past. Obviously, we cannot be 100% sure that the past will be repeated, but past does give some sort of indication as to how our strategy performs. So that is what I can tell you. In the past, whenever this has happened, we have recovered at a much more faster pace as compared to index. So if you are a long-term investor, I really, frankly, do not see any sign of concern. Although I do agree in the short run, this is causing some pain, your portfolio being down 22%, but in the long run, I really, frankly, do not see any cause of concern. Now, this is related to our investment methodology. What is your primary source of alpha? Given that you churn stocks monthly, it seems unlikely to be stock selection. So, Mohan, I don't have the exact number, but if you look at the source of alpha, the source of value that we are able to provide, it is coming from both, from the factor timing as well as stock selection. So it's a combination, fairly good combination of both of these factors. And however, from time to time, one could be more, another could be less. But over long run, we do find that the alpha is coming from both of these factors, which is stock selection and also factor timing. Right? सुमित has asked, सर जब मार्केट में बड़ी गिरावट होती है तो लॉन्ग डेटेड ऑप्शंस इंश्योरेंस की तौर पर रिस्क मिनिमाइज करने के लिए लोग क्यों नहीं खरीदते? So Sumit, it's not that straightforward. First of all, these long dated options, these are used primarily to hedge your portfolio. Now, what usually would happen is, no, first of all, nobody can time. So nobody knows कि ये market correction होगा, right? In a rising market, अगर आप options लेते हैं as a hedge, so that there's a cost involved. So every year, maybe it could be 3 4%, but every year your returns would be slightly lower because you are buying your insurance, right? So in a rising market, it really hurts you. Now, in a falling market, obviously that will help you. So you won't have as big losses. But overall, see, over long run, if you're paying 3% additional cost almost every year to hedge your portfolio, and out of 5 years, 1 year you are able to protect your portfolio, then it's not really a very big difference, right? Every year you're paying about 3%, 3%. So for 4 years, you would have paid 10 to 12%. और एक साल जब गिरावट हो रही है उस टाइम आपने अपना लॉसेस बचा लिया तो इट्स नॉट वेरी स्ट्रेट फॉरवर्ड इट्स नॉट दैट इट विल always help you. And at least in our experience also, we have tried to develop a methodology where we try to time the market, where we shift to cash. But over long run, we don't believe that really helps. So over long run, it really is a better strategy to stay invested. However, it's up to you uh, overall because here we are providing uh, specific portfolio. So let's say if you have a view that markets are going to correct, so instead of gear 6, you might as well shift to a gear 5 or a gear 4 where you have some bit of debt also. So that is one way of minimizing risk. But otherwise, speaking about our multi-factor methodology, we do minimize risk in our portfolios in the sense that when the markets are not rising, when the markets are volatile, at that time, the way our algorithm works, it shifts to safer factors like value, like quality, and that helps us allocate capital to safer stocks. This time, I agree, it has been a fairly broad correction that we have seen, and that's why it hasn't really helped us. But again, over long run, we believe our strategy of minimizing risk using the factor timing is really a very effective one. Why does your portfolio suddenly buy a large number of stocks, lose money, and then reduce the holdings? Virinchi Gogoi. So I think you're talking about the changes that we made in October and November. We are now behind that. Those are the changes we have made for the better, because there was one specific block, which is the uh, sector block, in which we are also figuring out or ranking these sectors. So prior to that, we were only ranking stocks. After that, we started ranking those sectors also, and that specific block is when we added, and then we still had that, but due to uh, the findings or the improvements in research, and also due to the feedback, we moved, we reduced the number of stocks. But methodology wise, we moved on to the newer methodology, which had the sector block as well, which is actually a better way. So it's an improvement from our older methodology, and that's why we made those changes. Having said that, I don't see any meaningful or big changes in the near future that you'll observe. So this, I think you're talking about the October, November changes. Dipanshu is asking, Gulaq large cap is more volatile than most large cap small cases. Can we consider shifting to gold debt when the quant model shows significant drawdowns and start exiting stocks? I'm comfortable with volatility, but frequent exits might lead to capital restriction. So Dipanshu, again, see, this is something that we have from time and again uh, invested a lot of our time in researching models where we shift to debt or gold. In our view, it's not a very good thing to do. Now, in the hindsight, it looks very easy that we could have avoided these losses. We could have shifted to gold or debt. But again, this is very, very hard thing to do. And this is not only a single decision. These are two decisions. And in our experience, it's very hard. It's very hard to add value when you say that you want to shift to debt or gold when the equity market start correcting, and again you move back. uh, there's no systematic way we know of doing things, and that is why we are always fully invested. We believe this is a better approach, also because see, when the markets are rising, and you saw returns, the yearly returns, just go back, yeah. So even in 23 and 24, we combined these 2 years, we delivered about 85% returns, right? And sometime mid of 23, the science or the news started coming in that the markets are overheated, maybe in small cap, maybe in mid cap. But because we were fully invested, we were able to provide these kind of returns that we provided. Had we shifted at that time, we would have missed also. We would have avoided some bit of losses here, but we would have avoided these phenomenal returns also, right? So it cuts both ways. It's not that simple, and again, in the long run, we believe it does not really give you very good advantage. Uh, yeah. Why did we shift to safer investments when the markets? Again, I think this is what I have covered. That's not a straightforward thing to do. It's very, very hard to time the market. We do not want to time the market. We want to stay fully invested. You have given us money to give you the best returns from equity markets. And over long run, we are quite confident that we'll be able to deliver that. We have delivered that in the past also. So that's what it is. However, at your end, I think you should definitely do this asset allocation. So let's say if you are invested in Gear 6 and you are following a 60-40 approach, which means 60% of your assets are in equity and 40% in debt. So what would have happened in last 6 months is that your debt obviously keeps growing consistently, whereas equity instead of 60, if that is down, let's say 20%, so equity would have become, instead of 60, it would have become 48. So now if you rebalance your portfolio, what you'll need to do is move some part of your money from debt to equity, and that is happening at lower levels. So if you keep rebalancing your portfolio, if you follow a fixed asset allocation, and from time to time, if you keep rebalancing your portfolio, that's a very, very good way of having a stable portfolio over long run, and also uh, rebalancing or market timing, because at this stage you'll be moving money from debt to equity and making it again 60-40. And as and when markets start rising, when this 60% becomes, let's say, 70-30, at that point of time you will be booking some part of your profits from equity and shifting to debt. So that's a very good way of timing the market that you can actually follow at your end. Okay, so I've covered the questions that we got. I'm happy to take more questions.
Yeah, so we have received a few questions in our chat box as well. Anybody else who wants to post their questions can do so in the chat box. If you have any queries or feedback for us, we'll be happy to address those. The first question is by Rajat Dumir. Should we increase SIP in small cap and mid cap mutual funds considering the index is down around 20%?
I think the best approach, frankly, in my mind, and that's what I personally also follow, is follow the flexi cap or multi cap approach, in which investors give their money to the fund managers, and then the fund managers decide where exactly to allocate that money wherever they see fit. So that is, I think, the best approach that most of the investors should follow. If you are an experienced investor and you want to take bet on specific market cap, as I've shown in the past slides, that large cap definitely is below their longer term valuations in terms of PE. It has come now below. And small cap also is not below, but definitely closer to their longer term average. Mid cap is still, there is some overvaluation there. So if you ask me in terms of valuation wise, the best placed is large cap, second best is small cap, and then mid cap in terms of the attractiveness that I see. Now, having said that, as I said earlier, for most investors, what would make good sense and a very simple approach is to follow a multi cap or a flexi cap approach rather than investing in individual market cap based.
All right, Vivek. Next question is invested in year six since Feb 24 till date 1 year. Return is minus 27%, which is huge. So they are losing confidence.
Yeah, see, I can imagine. I talk to a lot of investors almost on a daily basis. There are many investors uh, who have been with us for 3, 4, 5 years, right? And they are pretty happy. Obviously, they don't like these corrections, but they are happy and they are very, very confident because in the past they have seen, they have experienced the kind of returns that I just showed on slides to everyone. Whereas the investors who have been just with us for past 1 year would be more, definitely much more concerned. But I think every time, that's what we say, this is not really about gear six. It's about any equity investment. So, had you been invested in, let's say, any of these, most of these mutual funds, obviously some mutual funds are less down than the others, but this is a story with almost all the investors who have started in 24 that overall since beginning their portfolios are in red, right? But if you consider the longer term, if you are actually a long term investor, and frankly I am a longer term investor, I think in terms of next 10 years, and I get very excited. uh, I know it pains a lot of investors, but the way I personally think as an investor is that right now I'm getting the opportunity to invest at a lower level. I do not need the money in next 1, 2, or 3 years. I would maybe need money in 5 or probably in next 10 years. Uh, so I'm getting this opportunity to invest in markets at much more lower levels. So if I'm putting, let's say, 20,000 every month in markets, with that same 20,000, I'm able to buy more number of stocks or more units in a mutual fund, right? So this is I think, frankly, a very good approach if somebody is following a systematic approach. And actually, if you look at it, uh, let's say there is one thing as the price returns. So let's say if the markets are at one point of time, I think 26,000 or something was the high in Nifty. Currently, it's around 22,000. So it has corrected about 4,000 points, and investors are in loss. Now, for somebody who is doing a SIP and he keeps doing it, and let's say Nifty recovers in, say, next 1 year, okay, it again in the next 1 year goes back to 26,000. So the overall price returns from 26,000 to 26,000 will be zero, right? So somebody had invested at 26,000 and hasn't done any investment. So for the next, let's say, 2 years, it took the recovery. His investments would just be at break even. But for someone who has been doing SIP, every month he has been putting money, for them, there would be somewhere between 10, 15, 20% returns, depending on how much money you are putting in these lower levels. So somebody who is doing a SIP for these 2 years, markets would have only recovered, but he would have made 10, 15, 20% dependent on how aggressively they're timing their SIPs, right? So markets could give you 0% returns for 2 years, but the SIP returns would be non-negative, they'll be higher. And this is what we have seen in the past also. Whenever these corrections happen and recovery happens, your price to point returns are zero, but SIP returns are actually positive and they're quite healthy. And this is what would happen with any investor who just continues doing SIP during these times, right? So yeah.
Right. Right. Yeah, you mentioned it correctly that it's in these times that excess returns are actually made. So in theory, it is very simple. The approach is very simple that we just need to keep investing and do SIP. The tough part is to actually practice it. But yeah, I hope that the investors do take advice from you and just keep doing the systematic investing. And even though having the portfolios in negative, have a positive outlook towards the market. The next question is by Soma Dipta. What's your view for the current market? Should we expect more correction and more pain? I am at minus 17% in year six.
Okay. Uh, I frankly, I'll give you an honest opinion. I have no idea. Short term, we don't take a view of the market at all. I might have my own bias, but frankly, that is useless. Even for me, I don't use it. I practice systematic, disciplined investing. And in the short run, if somebody is saying that they know where the markets are going, uh, they are intentionally or unintentionally trying to fool you only. I do not believe this is anyone can do, but more importantly, it's not even required, right? As I explained in my previous question, that no matter where the markets are currently, if you are a long-term investor and if you keep doing monthly investments through a systematic investment plan, it really does not matter. It's not a very big or even a minor factor, frankly. It's a very, very small factor that where the markets would go in the next 3 months. What matters much more is whether you are able to keep investing during these times or not. So I think this is not the right question. I do not frankly know also, but the more important question would be whether you are able to consistently put in money at these levels or not. That will determine the overall portfolio returns. That will have a much, much bigger impact than where the markets go in the next 3 months.
Next question is by Mr. Shiva. My portfolio is down again 25%. When can I top up for Gulaq Year 6 to take advantage of the correction scene?
Yeah. So I think it's similar approach what I've been saying, that I do not know when the bottom would occur. The best approach is monthly, and this is not for Gear 6, but equity markets in general, that on a monthly basis you keep putting in money, and that's actually very simple and very, very effective approach.
The next question is by Mr. Arun. Did you get any feedback from small case about adding additional amount or doing SIP when rebalancing?
I'm afraid, at least I haven't heard anything. Simran, you have any inputs
Uh,
on that?
no, we do not. So that is
Yeah.
still a capability that small case has not developed yet. But we have definitely taken this feedback and told it to small case, and they're looking at it. Okay, the next question is Mr. Vivek had mentioned that he will share a blog on the rolling returns of the strategy on one of the earlier EMAs. I would just like to remind that, and he looks forward to reading the same.
Yeah, sure. We have done that analysis. I think it's not published, but definitely this is something you can expect in the next couple of days. We'll definitely publish this as well. Sure, I've noted this.
The question is by Srinivas. Is it good to average the stock which is down in the portfolio?
No, definitely not. See, you are anyways paying us to give you the advice, and we are considering all the factors that at least we understand and taking that into account and giving you advice to buy or sell, right? So you might have your own biases. You might have heard few things about a specific stock that why it's a very good investment. Uh, and for most investors, that kind of investing really does not add any value. Rather, it creates a negative value overall in your portfolio. So I don't think you should try and complicate things. What I would advise is if you believe that you have good skill set and ability to analyze and pick stocks, what I would advise is keep Gulaq Gear 6 separate, keep following the advice that we are giving you, and in a separate portfolio, you pick your own stocks and then invest. And over time, you will get to know how well you are doing as compared to Gulaq Gear 6. And if you believe and if you are able to do well, then obviously it's a good approach you are doing. There are very few investors who would be able to do, but if you are able to do that thing well, then move your assets from Gulaq Gear 6 to your own investing style. But I wouldn't really recommend to mix these two approaches.
The next question is by SK. They have provided their investments in Gulaq Q6, basically the amount they have invested from time to time, and they want us to break his returns down, and they are 25% down right now. So I believe it would be better if they can get in touch with our support team so that we can have a better look at this. I will just
Yeah,
post
sure.
our email address, and they can write to us over here. So please feel free to write us on this email and we can definitely look at your returns. I would request the audience if they have any more questions or feedback for us to post the questions. Okay, so Mr. Shiva has a follow-up question that should I not do top up in Gulaq Gear 6 portfolio?
I think Shiva, it's totally about following a disciplined and systematic approach. So in all your funds, I think it's always good to uh, if you are saving money from your salary and investing every month, it's always good to put in money every month on a monthly basis in these funds. So that's what I would recommend. That's the really very simple but very effective approach.
I hope this answers your query. Just want to check again that if there is any open questions from the audience that they want us to take, we can take it right now. Okay, so Mr. SK is saying that they did get in touch with our team in the past, but they did not get satisfactory returns. So they wanted to directly put the question to you, Vivek.
So I'll definitely check with the team. I think we should have your email. So I'll check with the team and provide and see what kind of analysis you need, and we'll definitely help with that analysis. We'll do that.
That was the last question from the audience, so we can
Okay,
wrap it
great.
up. All right. Thank you, everyone. Thank you so much for joining. Have a good night, and we'll see you next month.
Thank you, Simran. Thank you, everyone. Bye.